Peter Mcguire, CEO of XM Australia. Peter, your thoughts on this debate, and particularly where do you think it impacts the financial investors? We saw in early September during the APEC week in Singapore that net shorts outpaced the long for the first time ever. How does something like this attract the financial funds back into the oil markets, or does it scare them away? Your thoughts on the impact for the market dynamics and the price of oil?
Well, Sean, I mean, when you're looking at, and welcome and nice to say hi to everyone from Sydney. Brent's sitting at 71 and three quarters. You got 67.80 for November WTI. It's very, very choppy, as you know. And I mean, it's just been extraordinary. Yeah, the US dollar come under pressure. We're not sure as far as what we're doing as far as rate cuts in the sense of the size of them leading up to the end of the year for the US. There seems to be a continual drag down from everyone saying we're cutting. ECB, Swiss did yesterday, 25 basis points. So as we're seeing all of this work through the market, Sean, while you've got, and you said net shorts there seems to be plenty of opportunity for retail traders anyway to trade the market. That's the beauty of it, because it's so wild and you've got these big swings, which are very attractive. So I don't think the focus has gone off from a trading perspective. Where do we see a bottom out? I wouldn't have thought this time in the last few days you'd be sitting here sub 68. I thought you might have WTI the best part of 72, 73, but that hasn't been the case. So there's plenty of the big hedge funds and everyone's just moving the market as much as they can to see opportunity. Where does it move from here? I wouldn't be surprised, maybe another $1 or $2 drifted out of it, and then it'll bounce and it'll go back up, and I think just repeat the same old series that we've seen over the last couple of months. There's plenty of money to be made in other markets at the moment as well.
But you don't, Peter, you don't think that, I mean, this FT reporting, which is indicating, a sort of a drowning of the market going forward, drowning or certainly opening the taps or whatever metaphor you want to use, ultimately more oil than the market wants, that obviously the price dropped off yesterday. Is that it? I mean, does this market lose more on the ground? I mean, Libya is due to bring back 500,000 barrels now that they've done a deal.
Well, exactly, Sean. So that's why I'm thinking it's got a couple of more bucks to be stripped out of it. And, let's see where it is at 64.5, 65. If it's there, it might snap through that. I mean, there are so many variables that go into seeing where price discovery is going to be. But at the moment, we're certainly in a downdraft with extra barrels coming online and the likes of Saudi coming out. It'll be a fascinating end of quarter because we're only 40 odd days from the Trump / Kamala Harris election. If she is the presidential candidate, we still don't know that really, but I would assume it is.
But she's still the candidate, but whether she wins or not, we will see.
And the impact that has, naturally, if President Trump's saying he's going to drill, baby, drill, then what impact is that going to have to price as well?
Well, I mean, we have a hard time to convince ExxonMobil to drill, baby, drill if it's going to knock some dollars off the barrel. Peter, the other big news this week that, again, alongside of, as you listed off there, all of the monetary easing that's going on around the world and in a sense only beginning, but we've also, and that also included China this week, and we've seen China's stocks are heading for their best week since 2008. I mean, that's like a long time ago now, even though the financial crisis still feels very present in the trauma that it left. But ultimately, China, where's China at? Where's this stimulus? Is it going to, is that the defibrillator bringing the beast back to life? Your thoughts?
Well, I don't know whether it's bringing it back to life, but if you just, let's look at as far as the performance, Sean, it's been extraordinary. You've got the Chinex index up the best part of 22.5 for the month. That's percent. And you've got the CSI 300, and we always throw that one around. That's nearly up 12% for the month and 4% today. So it's been extraordinary. The market, I think everyone's buying into the storyline. You can't say it's not happening. You've got very strong numbers across Hong Kong as well. So the overall momentum has got to say that it's been a successful initiative by the Chinese government, the bank, to try and stimulate positive sentiment. So there's the first part. The second, so everyone's bought into the story. The second part, how long it's going to take, you were saying as far as that 5% GDP target, Is that going to be watered down? Is it going to be achievable? We've just got to wait and see. And naturally, you've got a property, we say it nearly every time we're on together, the property overhang is something that the government needs to really address, and really address it quickly. And is this going to be enough of a panacea to stabilise the property sector? Only time can tell, Sean. But you can't argue with the numbers when you're at these sort of levels since 2008. It's really quite extraordinary.
Let's go to the survey question, which of course addresses this main point this morning. The OPEC Plus has no choice but to trigger market share battle because oil producers not bound by supply cuts are adding more new production than annual demand growth. Peter, last word for you. I wanted to get so there's a disagreement in this room to my thesis. Peter, I wanted to get your thoughts because I'm trying to, as we put the pieces together, what does gold keep hitting records for or mean to you at a time when we've seen that we're in a monetary easing cycle? Inflation is supposedly locked away in a box now. Why is gold keep meeting new heights and not stopping? 2006 or something at the moment.
Well, Sean, 1800 start of October last year, I think it was 1807, and now you're sitting at 2700. Anyone doing the math, it's nearly 50%. There is obviously a level of fear. You've had incredible central bank buying over the last decade or more, and certainly been heightened up as far as aggressively over the last 3 to 4 years, the likes of India, Russia, China, you name it, Turkey. So there's the first part. Second part is, Sean, you've got the paper market and the physical. There's huge attraction, the paper market as far as retail traders, and the store of wealth as far as retail, and every man and his dog is buying gold and putting it under the bed. So record sales from jewelry production and everyone buying bars. So there's that. I think there's a lot of fear in the market with a fully priced equity market. If it does take a dip and if it does wash out, there's a place to be. I think the inflation story frightened everyone, and I don't necessarily think it's over, and I'm not sure because it is cumulative, and we've got to be conscious of what the cost of goods are where they were 3 or 4 years ago. And I think that there is a degree of it was probably held underwater to some extent, and it's really starting to rage ahead aggressively. So the storyline is, Sean, it's onward and upward. Many people are saying 3,000 by end of year. And the rapid aggressive move from 26 to 2,700 has been literally done in about a week and a half.
Well, I don't think we've ever seen, or I can't remember, when the Fed has cut 50 basis points, when the US economy has been enjoying full employment and inflation is still above target. It's no wonder gold is going up, because I think there is a third corridor now in which the Fed is managing, although it's not its mandate, and that's the US government's ability to pay its debts. And that's becoming a factor.